I've got 5 financial metrics plus a bonus metric that I think every online business should be paying attention to. That's what we're talking about on today's episode of the Profit Pillar Show. I'm your host, Parker Stevenson, CEO of the accounting firm Evolve Finance and author of the book Profit Pillars. Now, I've seen a lot of business owners really run the gamut in terms of the degree to which they prioritize really any metrics in their business. Now, I would say a lot of online business owners are going to stay focused on maybe more marketing-based metrics because for so many small businesses, your ability to generate leads and find new customers is so crucial, especially if you have a offer or have offers that have a high turnover rate, right? Like at Evolve Finance as an accounting firm, we have a very low turnover rate. Our business has a lot of recurring revenue from it, from the bookkeeping service, from the yearly tax services. But for instance, we've had clients who have sold millions of dollars in one-off courses, but for every person that buys a course, well, who are you going to get to buy that course next? So it would make sense that these businesses are so focused on their marketing and sales metrics. But there is, I think, a misconception about finance metrics for small businesses because, as I've talked about in my book, Profit Pillars, a lot of small business owners think financial metrics are going to be things that are just going to be too confusing for them to follow, and they need like a financial expert to be tracking this stuff. And in my experience, it just couldn't be further from the truth. Now, do large corporations need to have more advanced financial metrics? Absolutely. Do e-commerce businesses have more complicated financial metrics? Businesses that are holding inventory or manufacturing physical products and then selling those products directly to the consumer? Absolutely, because the cost of inventory, the cost of manufacturing a good does make the financial aspects of running that business a bit more complicated, and you probably need someone with a bit more expertise to help you keep track of the things that you should be keeping track of. But so many of our clients at Evolve Finance, physical products are a very small part of what they do. What they do sell a lot of, though, are digital products, of services, of I wouldn't say passive income models, but like royalties or sponsorship deals. Again, kind of blur the landscape of service-based businesses and digital products. So these types of businesses, there's no physical product they have to keep track of the costs for. So that simplifies the finances just tremendously so. So that's where, again, a lot of these types of businesses, the types of 6, 7, and even 8-figure businesses that we work with at Evolve Finance, they kind of come into the financial landscape of their businesses whenever that kind of turns on for them, whether they were paying attention to their finances from the start, or maybe they grew a 7-figure business and are just now starting to take their finances more seriously. There's always some confusion or some intimidation around, all right, well, I saw this like fractional CFO on Instagram or LinkedIn say I need to be doing all these things. And a lot of the times you don't. So I want to demystify this a little bit because honestly, most businesses aren't paying enough attention to the basics. And that's something that we believe in a lot at Evolve Finance because we're not fractional CFOs because our clients don't need it. And we have fractional CFO partners that if our clients do want to work with someone for budgeting and forecasting, absolutely, we can help our clients find a great fractional CFO. But a lot of the key metrics that a small online business, and again, small is really under $20, $25 million a year, what they really need to know are their basic metrics. And if they know those, that will guide them towards, well, what are the maybe other metrics we need to be paying attention to? And we're talking basic here, really simple. And that's what I want to go over. And I want to share why those metrics are so powerful, even though they seem so rudimentary. Okay. So I've got 5 metrics plus a bonus metric. That's like slightly more advanced, but not really. But again, we can't compare ourselves to Silicon Valley startups. We can't compare ourselves to large corporations when it comes to finance. If you have a simple business, an agency, a service, an influencer-based model, an online education-based model, this is for you. So let's start with number 1, revenue. It's that easy. But it's amazing how little small business owners or modern small business owners look at that number and really know how much money did I make last month. And this is where your bookkeeping can really help with this, because sure, like we have clients where they'll track their revenue in Stripe, and that's great. It's good to track in your merchant account on a daily or weekly basis. But when it comes to the end of the month, if you want an accurate number of what hit your bank account in that month, not what Stripe tracked, but what actually hit your bank account in that month, and the more money you make, the more off this will be in terms of the variance between what your merchant account said you collected this month versus what actually transferred to your checking account. That's where good bookkeeping is so powerful, because, for instance, at Evolve Finance, we know how to track what happens in PayPal and in Stripe and in any other merchant account to make sure that revenue is accurately tracked on the P&L. And knowing exactly what you made that month is so important, because if you're also kind of keeping track of a monthly expense budget, then you should know or have a good sense at least of how profitable your business is going to be based on what revenue targets you hit. So you should kind of know, all right, if we don't make X amount of dollars this month, we're probably going to lose money, or we're only going to break even, or, what's the number where you're going to hit the profit margin you really want to hit. So revenue is really underrated. And I just find a lot of business owners pay more attention to what's in their bank accounts instead of what does that revenue number on the P&L look for. And that's the top of your P&L. When we know how much money the business is actually bringing in, not what it has, not from an accrual standpoint where, well, we got these contracts coming in, or I think we're going to have some more clients that are going to onboard, or whatever it may be. What did we make this month, or what did we make in the last quarter? What have we made so far this year? That number will then dictate, do I need to take action in terms of what we're doing with our expenses? If we're under where we thought we'd be from a revenue standpoint, all right, we got to maybe cut back on expenses or rethink what we're spending our money on. Or if you're on track or way over, then you go, hey, we're getting really busy. The money's coming in. Maybe we need to make some investments in the business, hire more people, do whatever we got to do. So knowing where you're tracking from a revenue standpoint, especially as it relates to what you thought your business was going to make so far for the year, is extremely powerful. It's so insightful, and it's simple. But you got to pay attention to your books. You got to be looking at your profit and loss statement each month to see this and know, like, what did we do last month? What are we doing so far for the year, quarter, whatever time frame you want to look at. The second metric that enough business owners aren't paying attention to is profit. And profit's a really important number to understand. And you might be going, well, bro, I understand profit. It's your revenue minus your expenses and what do you have left over. Yes, profit in terms of the math is very simple, but from an accounting standpoint, we find a lot of business owners are confused about what their profit number is in terms of what they're going to owe on taxes versus the third metric we're going to talk about here, which is cash flow, the actual money they have left over after distributions, after paying off loans, etc. That's a different number. So this is just profit, right? Just what's the money we have left over after our expenses. And this number is the key indicator to the health of your business. Because if your profit isn't in a good place, you immediately can go back up onto your P&L and go, is the profit not in a good place because we're overspending, or is the profit not in a good place because we're simply not making enough money? Expenses are actually okay. We just simply aren't hitting our sales targets. I know that sounds so freaking simple, and that's because it is. The complexity here is your bookkeeper doing a good job of actually tracking the revenue and expenses in your business? That's where it kind of gets confusing. Or is your bookkeeper not doing a good job of delivering clear and clean financial reports, like a P&L statement that makes sense for your business model and looks good? And this is where the larger your business becomes, the more important it is that your bookkeeper does have a perspective and frankly isn't just doing whatever you want them to do in terms of categorization and chart of account setup. Really, your bookkeeper should have a perspective on how do we make sure we have the detail we need for the accountant to file taxes and to gain insights into the business while also not turning the P&L into a large mess that now you as the business owner don't want to look at. Sure, maybe you can scroll down to the bottom, see the net income and go, okay, we're either on track or we're not. But if you can't go back up the report to see, well, how did the profit end up the way it did last month or last quarter or for the year or for last year? That's really important because that's the first crumb in the trail of clues that you use to then go and figure out why or why not are we hitting our profit targets. And it's that simple because especially if you run a cash basis type business where accrual accounting, where you need to be managing future expenses and tracking when revenue is recorded, not necessarily when it's collected. That's a whole nother story that usually is for e-commerce businesses or larger businesses. But for small businesses, it's so simple. Did we keep some of the revenue we made? Did we make more or did we keep more money than we spent in business expenses? And that's the first place to track. I talk a lot about that in the Profit Pillars book. So I mentioned it already, but the third metric is going to be cash flow. Now, cash flow is different than profit because your profitability, that net income line on your profit and loss statement, is going to focus on how much money do you have left over after all tax-deductible business expenses. But there are some cash flow affecting transactions, things that will happen in your bank account that don't affect the P&L. For instance, if you take $5,000 out of your business and transfer it to your personal account, we don't get to write that off. That's called a profit distribution. That's going to show up on your balance sheet under profit distributions or dividends or whatever your bookkeeper or accountant is calling it. We talk about that in Profit Pillars as well. But that's now $5,000 that's not in your business's checking account. So it's a cash flow affecting transaction. The business now has less money, but it does not affect your profitability. And that is a really important concept to understand because we've had business owners where it goes, well, it's saying I have $250,000 in profit for the year, but my bank account only has $30,000 in it. What's going on with that? And it's like, well, you transferred six figures to yourself or you were paying off a business loan. So these are things that again, affect the amount of cash the business has on hand, but has no effect on the profitability. You don't get to write off loan payments. If you took a loan out in your business, you get to write off the interest, but you don't get to write off the actual loan payment itself. Just like you don't get taxed on the loan income that you get when you take out a loan. But same with paying your taxes. If you're paying your federal income tax, and you pay it out of your business, that's going to reduce the amount of cash the business has, but it's not going to affect the business's profitability. It's not something we get to write off. So that's where cash flow is really important, that you can see, all right, I need my business to make $20,000 a month in profit on average because I need to be able to transfer $10,000 to myself each month. I need to save for taxes and I need to save for a loan, or I need to pay off a loan that I took out in the business as well. Well, then, okay, you might not have very much money left over in the bank at the end of each month if that's the case. So it's important that you understand what your business's profit is, but it's also important that you understand the cash flow affecting transactions that are happening in your business that aren't going to show up on the P&L, but are going to show up on the balance sheet. And so what's the cash flow at the end of the month? Because it may be significantly less than what your profit is. And if you're trying to save up 3 months of expenses in your business, which we're going to talk about in a second, or you are trying to save up for a big investment in your business, then if you're not getting there as quickly as you would think, given how profitable your business is, then chances are you have cash flow affecting transactions, again, like distributions, like paying down loans, that are going to affect the amount of money you actually have to work with at the end of each month in your business. Now, the good news is for a lot of online business owners, it's rare that they're going to have massive loans the way, again, maybe e-commerce and manufacturing businesses might have to take out in order to buy new equipment or purchase inventory or whatever it may be. But it still happens in these businesses more than I think a lot of small businesses would realize, especially the larger the business becomes. As our clients get into high six-figure range, into the multi-seven-figure range, that's when there's more cash flow related activity, especially because hopefully the business is profitable. The business owner is taking out a good amount of distributions to pay themselves, but it does deplete the business's cash flow. So just to recap here, first metric is just revenue. Do you know your revenue? 2, do you know your profitability? 3, do you know your cash flow, the money you have left over after your profit? And then the fourth one is going to be savings/cash reserves. Because for us at Evolve Finance, again, I talk about it in Profit Pillars, we really believe in having a 3-month savings cushion in your business. 3 months of being able to cover the full amount of expenses in your business on a monthly basis. So what are your total expenses each month in your business on average? That's what we want you to save up as cash reserves in your business, not putting it somewhere that's not liquid like the stock market or a CD, having that cash available in your business so you can utilize that cash to manage cash flow during the months or during the times of the month where maybe you have some big expenses to pay for, but your revenue collection isn't happening until after that. And this is common with a lot of service-based businesses and agencies. So having that 3-month cash reserve makes the business so much easier to manage, because there's a catch-22 that I've seen a lot of businesses get into where cash flow is tight. The business is making money, but it's spending money at an almost equal rate, or maybe even spending more than it can afford. And so it puts the business in a situation where they're always struggling with having the cash they need during certain times of the month in order to pay all their bills. And so in order to fix that, they tend to have to spend more money on like a fractional CFO to help them really track their cash flow, because it's a tedious process. Even if you're doing accrual, it's very tedious to be tracking. All right, when do we think money is going to be coming in on a daily basis? When are we going to be spending or paying for expenses on a daily basis, and tracking that in a spreadsheet? It's a lot of work, and it's going to cost the business more money to track that. So that's why the goal here is that you never get to a place like that unless your business is so large that just becomes a natural flow. The business is profitable, but it just becomes more of a thing to have to track the cash flow on a daily, weekly basis like that. But for most small businesses, they shouldn't have to do that, but it does happen. And so the way you avoid that is as early as you can in your business, get that 3-month savings cushion. And if that means, all right, let's just get 1 month savings cushion first, that's usually a game changer for a lot of businesses. But there is a little bit of discipline that has to happen there, because in order to build a savings cushion in your business, that means that's money when you have a profitable month, profitable year, that's money you're leaving in the business instead of taking out to pay yourself. And that can be really hard, especially depending on how much money or how profitable your business is, what your personal expenses look like. If there's not a big enough gap between the business's profit and what you need to make as the business owner, then it's going to be really difficult for you to build those savings if that amount of profit is about the same as what you need to save for taxes and pay your personal bills. So we have to create a gap between your profitability and what you need to make. And that means as your business grows, maybe not allowing your cost of living to go up quite as much, because as people make more money, they want to buy that new car. They want to put the down payment for that new house. They want to go on that big vacation. And if you can afford to do that, great. But we've just found that prioritizing that savings and cash reserves really puts the business owner in a better mindset, because they know they have a runway, they know they have a cushion. And when they have that, they start to think from the perspective of long-term strategy instead of daily reacting to what the business needs just to stay afloat from a cash flow standpoint. And that is a massive shift in perspective and just such a relief when you can put yourself in that situation. And chances are, if you save that money up in your business, it's going to set you up to be able to make more money down the line, because you're going to be able to make decisions for the long term and not constantly be making decisions for the short term. So don't underestimate that savings cash flow reserve and making sure you know what that number is and looking at your bank accounts every month, looking at what do we have in terms of cash in our various bank accounts and subtracting out credit card debt, other loans to see what do we really have in terms of cash to work with. Really important metric. The fifth one is know your profit pillars. And I understand not everyone listening to this is working with us or has read the book and is using our profit pillars sort of P&L setup. But out of the profit pillars, there's 4 of them, there's 2 that I think are really important. And the way your bookkeeper categorizes your transactions is going to have a major effect on your ability to track these certain, bigger buckets of expenses at least easily, right? If it's not convenient and easy to look these metrics up based on how you set up the P&L for your business, then chances are you're not going to look at it enough and really get to know these metrics. But the 2 most important ones for most modern small businesses are the team costs, or your labor costs, as we call them in the Profit Pillars book, and your lead and conversion costs, which mostly consists of sales and marketing expenses. But there's a lot more detail into what subcategories of expenses fit into the labor category and the lead and conversion category. Now, the other 2 pillars are offer delivery expenses and operating expenses. Typically, those tend to not be as major factors to the profitability of the business, but depending on your business model, offer delivery expenses can definitely get out of control. But for the sake of this conversation, at a minimum, because our clients at Evolve Finance, they're going to know their 4 profit pillar metrics. What percentage of their revenue are they spending in each specific profit pillar? And then as a whole, what are their total expenses? But if you're not using the profit pillar system yet, then you should understand what are you paying for your full team costs, because team costs are by far the biggest profit killer if not managed properly. And I'm a big fan of hiring people, paying them well, but if you want to do that, you have to manage your labor capital really well. You have to make sure your team is operating efficiently, that you're maximizing their output so you can not only give them job security because they have a very specific role that is really helping to move the needle for the business, but also so you can afford to actually turn a profit and hopefully hire new people as the business grows. And so we'll talk about labor costs, as I'm sure, as a full episode at some point as it stands alone, because I could talk about labor costs for quite a while, because that tends to be the profit pillar expense that I talk with our clients about the most, because for any business to scale, and especially if you're in that high 6-figure, 7-figure, low 8-figure range, you probably got a team of contractors and employees, and hopefully a good amount of employees, more employees than contractors. And that becomes one of the most difficult things for these businesses to manage. So if you're not really paying a close attention to what are you paying for team costs on average each month, and what percentage of the business's revenue is going to labor, that can tell you a lot about labor efficiency. And if you're doing a good job of charging your clients and customers the right amount of money for the level of service you deliver to them, whether or not your team is efficient and effective at doing the work they need to do, if you're focusing on the right amount of projects in the business or focusing on too much. Like, there's so much that can be explored just by understanding the ratio of how much money are you spending on labor relative to the amount of revenue your business generates. Now, the other one is lead and conversion costs. This mostly consists of advertising costs, ad manager costs, affiliate expenses, merchant fees, things like that. I'm not going to go too deep into everything. Again, you can learn more about all of the profit pillars in my book, Profit Pillars. But given that so many online business owners consider themselves digital marketers or have to understand digital marketing to some degree, even if they're outsourcing to an agency and they're not doing it internally, I've seen businesses have make or break years depending on how well they manage their lead and conversion budget. Because if you're able to scale, let's say like an ad campaign, and it's not profitable enough, but it looks like you're looking at the metrics that let's say your ad agency is given to you, and like, oh yeah, we're making money on it. But if they're not making a big enough ROI on it, then you're going to see that on your profit and loss statement. And that's going to be really important to understand in terms of how do you change your marketing and sales strategies to get more out of that ad campaign. And it might mean your ad manager isn't getting a good enough ROI. It may mean your product strategy or customer journey has some issues with it. It may mean your sales team isn't converting at a high enough level, or your landing pages aren't converting at there's so many things to explore there. But what I've told clients for many, many years, if you're waiting to get your P&L from Evolve Finance to see how your ads are doing, it's probably too late. You should be working with, whether you're doing it internally and tracking it yourself, or you're working with an agency around something like advertising, then you should be tracking conversion metrics on a daily basis to tell you, should we turn on the ad spend? Should we turn down the ad spend? But then the P&L should be showing you, all right, what kind of ROI do we need to be making in order to make these ads worthwhile? Because even if the ads are showing that you're making more money than you're spending to Facebook, is it enough to cover your ad manager? Is it enough to cover your other expenses in the business? And that's where the P&L can help. But the actual conversion metrics and what you're getting for cost per click or cost per acquisition, those things you need to be paying attention to yourself, or working with your agency to make sure you're seeing those metrics on a daily or weekly basis. But overall, lead and conversion costs, affiliates, merchant fees, all these types of expenses, still really important that you understand how much you're spending on that stuff every month. Because if you have an average of around, this is what we're spending in this category, then that's going to make it easier at least for you to go, all right, then we got to make sure we're hitting X amount of dollars in revenue to cover this. So those are I'd say the two more important profit pillars for most businesses to be focusing on. But also I still think it's important for you to be tracking your offer delivery, operating expenses, because I do see those expense pillars or profit pillars get out of whack as well. Excuse me. I breathed and swallowed at the same time. The last bonus here, or the bonus metric, I think is one that I don't hear our clients talk a lot about. It's more common in, I think, the startup world and private equity and more advanced, maybe financial environments, but it's just average client value. Now, in the accounting world, we talk about this a lot with our business models. But again, I don't hear our clients speak to it as much. But average client value is just, if you look at all the people that have bought or purchased your offers, on average, how much are those people spending? Now, if you only have one offer and it's at one price point, you don't need to do any math here, right? If I got one offer, it's $9.97, that's all we sell, then the average value of your client is going to be $9.97. But if you do have multiple offers, especially for seven-figure businesses where maybe you have a tripwire, maybe you have an entry-level offer, then you have your flagship. Maybe you run a promotion where your flagship offer gets discounted during certain times a year. Maybe you have an upsell on top of that. Okay, now we're getting a little more complex, which is fine. But to be able to figure out on average, what are people spending? Because you'll have customers now that are maybe buying 1, 2, 3, 4 things from you. Then it's really important you understand on average how much are our customers spending here, and not just how much are new customers spending. How much are customers spending throughout their entire life cycle making purchases in your business? And that's, I think, a really important metric, financial metric to be tracking. It's not going to be on your profit and loss statement. It's going to be something you need to track internally in your business. but that would allow you to just kind of understand the customer journey you've set up. Are you and your business doing a good job of moving people through the different offers you have, especially if you're paying for advertising? If they don't buy your flagship offer, are we at least extracting some value out of the customer by offering them a discount or offering them a lower priced offer, right? This is where your automations and your email sequencing and the customer service components can really play a huge part around what you end up hitting from a revenue standpoint, because a lot of businesses are always thinking about, okay, how do I just sell to more new customers? And a lot of the time, the real opportunity, especially like in an economy like this, how can you sell more to the customers who have already purchased from you? Because the numbers show someone who's already bought one thing from you, those people are more likely to buy a second thing from you. So I don't think that's a strategy every business at every size can deploy, but I think the larger your business is, the more that average client value is really important. So if you want some help to get a better grasp of your basic financial metrics in your small business, we would love to help at Evolve Finance. If you want to learn more about how our accounting services can help you get more profitable, both from a P&L standpoint and a tax standpoint, then reach out. Just go check us out at evolvefinance.com. See if your business is a good fit and set up a discovery call. But if you also want to learn more about the profit pillars and the metrics that I talk about in that book, then go look for Profit Pillars anywhere books are sold online. But thank you so much, as always, for listening. Thank you for watching. I'll see you in the next episode.